Hello, everybody. Welcome to Monday. The S&P 500 was down 2.7% today. Unfortunately, it's a red shirt day. Kind of a wild weekend, actually. An interview that Trump had talked about possible for more tariffs, might be a transitionary period, might be some pain, wouldn't call for recession, but it was enough for the market to worry about, what they call the Trump put, which was always this thought process that Trump wouldn't let the market come down. He'd say the right things or do a few things to try to make that happen. Um, Obviously, forgetting the fact that we had these tariffs the last time the market dropped 19.6% before they stopped doing tariffs. We're down, what 8.9 or something like that from the high as far as that goes. These things can happen as far as that goes with the thing that fascinates me the most about this is that all of this market driven issue is based on surveys and thoughts about what might happen. So if you look at, the actual jobs report, it wasn't bad. I thought it was pretty good that came out on Friday. If you look at, actual retail sales, lower than December and maybe a little bit lower than expected, but there was a lot higher than expected in December. So maybe people spent their money there. If we look at the inflation reports that came out, moderate. Okay. So there's nothing that says here, hey, we should be dropping this much other than just the fear of what tariffs might do and, retaliatory tariffs and all those types of things. So rightfully so. There's some concerns about those issues. We've seen that in the consumer sentiment surveys. People are worried about the economy, the prices of goods. They're worried about the possible, future inflation, which jumped up quite a bit. I don't pay a lot of attention to those surveys personally. We've done a lot of back testing on them. Don't see a lot on there. What we do see a lot is when things get very pessimistic, you get a bounce. So, for example, I talked about the American Association of Individual Investors on my show on Friday. They put out a survey, a couple of weeks ago now or 10 days ago. 60% of the investors felt like the market would be lower in 6 months. That's only happened, six times since 1987. If you put little arrows on the chart like I did for my weekly show, it was at the bottoms of a lot of these things. The other thing that we watch for is called the relative strength index. It is just sort of a stretching mechanism. So when it gets really high, you can see it gets above 70. That's usually a topping point for market. When it gets below 30, that's usually a bottoming point. Matter of fact, the below 31 has a really good track record if you go back and look at it for the most part. We got below 30 today. So these bounces don't always mean that you're out of the woods. It just might be some relief before it starts to come down again. We saw one big pull down on the RSI back in kind of February, March of 2022 when the invasion of Ukraine was happening. And the market obviously did jump after that, but it didn't come back fully. It took all the way until October to finally get back to where it is. So you could be in for something like that again, but we'll have to see, just kind of go with the flow there. You still see consumer staples doing well. And for the most part, Europe is doing well, especially on a relative basis. So, real estate, healthcare, you look at the last month and the sectors of the S&P 500, staples are up. Healthcare is up and real estate's up. So staples and healthcare are often defensive measures because, people still need healthcare, for example, and they still need those staples, toilet paper, whatever it might be, almost no matter what happens to the economy. People are worried about recession. And, Trump isn't willing to dispel the recessionary aspect of it at this point in time. So, we'll see. The other thing that strikes me here, and I said this back in December, is that all of the things that the market doesn't like can be done very quickly at the beginning of somebody's presidential term. The tariffs, the mass deportations, the firing and downsizing of the federal workforce, the freezing of government contracts. They can all be done fairly fast, some of which probably should have gone through some more channels, but didn't. But nonetheless, the things that the market likes take time. Specifically, the unwinding of some of the regulations, and more importantly, tax cuts. So those aren't on the table. And I was worried at the beginning of the year and the end of last year that there'd be this gap. All the things that are bad the market doesn't like can be done right away, and the things that the market does like takes time. And so you end up with this kind of gap, and that's exactly where we are. We are right in the middle of this gap. So I think we have to be careful not to panic here. Again, this is not driven by fundamentals of a deteriorating economy per se. I do think we'll see some softening no matter what happens, just because consumers are probably going to sit back, CEOs are going to sit back. There's too much uncertainty here to stand forward and say, oh, let's go out and buy new cars or do different things along those lines. So I suspect we'll see some softening no matter what. Does that kick us into recession? Maybe, but the real aspect will be how long do they keep these tariffs into play? Is it an ongoing kind of negotiation trying to get concessions, or are these things permanently in there? We're looking at them, 4 years from now, and there's $1.5 trillion worth of tariffs and then counter tariffs and what have you. So, we still don't know that at this point in time as far as that goes. Kind of wait and see what the market is telling us. The market is now telling us that it's nervous. However, the 50-day moving average is still well above the 200-day moving average, which is a really powerful sign. What they call the death cross is when that 50-day comes through that 200-day moving average. That's a little ways off here, even if it does happen at all. So anyway, something to watch for day by day. Don't be surprised to see some type of snapback here in a short period, just because of the stretched down nature of the sentiment surveys and the actual, like the RSI indicator, for example, which has a fantastic track record on short-term overstretched, oversold situations. And you never know. Sometimes that can lead to a recovery. I don't see a big recovery